Welcome back to the Retirement Planning MadeEasy.com show and podcast, where we talk about retirement planning issues to simplify things, make it easier for you to focus on the things that are most important so you can have your best retirement. If this is your first time with us, my name is Chris Hammond. I'm your host. And on today's show, we're going to be talking about a little thing called IRMAA. And you may have never heard of IRMAA before, but it has an impact on your Medicare. So let's talk a little bit about this. What is IRMAA? IRMAA is an acronym, IRMAA. And what it stands for is Income Related Monthly Adjustment Amount. Income Related Monthly Adjustment Amount. And it applies to your Medicare. It's income related because if you make more money, have more income, they will adjust the premium that you pay for your Medicare. If you're already on Medicare, you probably already know that you have to pay a monthly premium for your Part B. Well, if you make too much money, IRMAA comes in and makes you pay more for your Part B. Now, this is something that's kind of big that we do talk about in the industry. So you may have heard about this. In fact, if you're the type of person watching a video like this, you probably have heard about this. Now, I came across an article I believe it was called White Coat Investor, that was talking about IRMAA and saying that IRMAA is not that big of a deal, and kind of broke down the numbers on that and showed, why is this something that everybody's focusing on so much to make sure that we avoid. So had some really good points in there. And a lot of the times IRMAA is not that big of a deal, but sometimes it is. And so we're going to break that down and go through when it is, when it isn't. Now, this chart here, and if you are listening on the podcast, I'll walk you through this, but this chart is showing the 2023 figures for how much adjusted gross income, it's actually modified adjusted gross income. There's a calculation, what your income can be before you start having to pay and be subject to IRMAA and having to pay extra money on your Part B. So, for instance, if you are married, filing jointly, a joint tax return, and you have $194,000 or less in income, then your Part B premium is going to be just the standard that it is, which is $164.90 for 2023. Keep in mind, depending on when you're watching this chart will be updated every year. That's how these things work. But we're just looking at 2023 numbers because that's when we're filming this video and recording it. Now, if you go above that, we'll just stick with married filing jointly. If you go above the 194 and you're in the range of 194 to $246,000, they're going to increase your Medicare Part B premium from $164.90 a month to $230.80 a month. So that's part of IRMAA right there. If you go even beyond that, the 246 to 306,000 income range, they're going to increase it to $329.70, and so on. It goes at the very highest level. If you make $750,000 and above for a married filing joint couple, your max Part B premium would be $560.60. That's for both of you that you have to pay. That's not just one of you. You would each have to pay that. So you can see how the cost can get higher over time the more you earn. Now, they also apply IRMAA to your Part D prescription drug plan if you fall into these certain income brackets. The first one, they don't add anything to your plan's monthly premium. If you have a drug plan, whether that's through a standalone Part D prescription drug plan or a drug plan that is included in a Medicare Advantage plan that includes prescription drug coverage in it, if you fall into some of these brackets, they're going to tack on top of that monthly premium a Part D IRMAA penalty, if you want to call it that, on top of it. The first bracket from $194,000 to $246,000, they're going to tack on $12.20 to your monthly premium, and it gets bigger and bigger. The max one, if you're making over $750,000 and above for a married filing jointly couple, they'll tack on an additional $76.40 to your Part D drug plan monthly premium. This is also in addition to the additional Part B premium that you'd pay as well. So there are some costs involved in this. The question is it that big of a deal? Well, sometimes it is, and sometimes it's not. So a lot of the on the article I read with White Coat Investor was showing about when it's really not that big of a deal. So let's look at an example on that. Let's say you're a married couple, you're retired, you're on Medicare, your adjusted gross income is 200,000. So if you recall, that's above the first threshold. So they're going to have to pay more for their Part B. So their additional Medicare costs are: spouse number one has to pay an additional $65.90 on top of that regular Part B price of $164 a month. They have to pay an additional $65.90 on top of it. Spouse number two also has to pay that. Spouse number one has to pay an additional $12.20 per month on top of their Part D monthly premium. Spouse number two also has to pay that. So the monthly total additional cost that they would have to pay under Medicare would be $156.20. Let's just multiply that by 12 and get an annual yearly cost. It's $1,874.40 of extra. We can call it, I don't know if you want a technical term, would be call it a tax. It's definitely an income related adjustment amount. That's what it's technically called, but you can think of it as a tax. Some people call them a shadow tax. So, but any way you look at it, it's additional money that's coming out of your pocket. So let's just do a little math. That additional $1,874 divided by their $200,000 of income, well, that comes out to 0.94%. So it's less than 1% of additional quote unquote tax that we're going to call that. Not really that big of a deal, right? Okay. Now nobody wants to pay any more tax, but it's not the end of the world. So it's less than 1% of income, but let's talk about when it may be a big deal, because there is actually scenarios where this is a big deal, in my opinion. When you voluntarily make more money on your taxes, voluntarily. So what do I mean by that? Well, one of the easiest ways to voluntarily claim more income on your tax is by doing Roth conversions. That's what you're doing with a Roth conversion. You are taking money that's in your IRA that's tax deferred, and you're saying, I'm going to choose to pay tax on this right now because I may be in a favorable tax bracket. I'm going to choose to pay tax on that and convert that over to a Roth IRA. And forever on out in the Roth IRA, it's going to be tax-free for later in life. Even what it grows to is going to be tax-free. Really good thing. So IRMAA may be a big deal if you voluntarily are making more money through Roth conversions. I mean, when I say make more money, I'm just saying you're claiming it on your income tax and you're paying the tax on it. And when you're on the cusp of going into one of those next, on the cusp of being exposed to IRMAA, because IRMAA is what they call a cliff tax. If you make $1 over the amount that it said, so I believe it was 194, something like that, on that chart we just looked at. If you make $1 over that, you're subject to the additional tax on that. Now, this is different than what we're used to with our taxation rate and our tax brackets, where if you are in the 12% tax bracket, the money that you earn that's in that bracket is taxed at 12, but the amount that you earn over that is taxed at the next bracket up 22%. And just because you're in the 22% bracket doesn't mean that every dollar you made before that is taxed at 22%. It doesn't make it all get hit that hard. It just makes the marginal dollars that went over into that bracket to be taxed at that. IRMAA's different. IRMAA says if you go $1 over that threshold, then we're going to pop the tax on you. You could have gone $50,000 over it or $1 over the threshold. You're going to pay that same exact additional amount. So if you're on the cusp and you are thinking about doing a Roth conversion, your Roth conversion may get taxed a lot higher than you think, and it may not be worth it at that point. So let me give you an example. You have that married couple again. They're retired. They're on Medicare. They're having to pay Part B premiums, all that. Their adjusted gross income is $190,000 now. So now they're not exposed to IRMAA. They're not having to pay it because they're below that 194 threshold. Now, let's say they choose to do a Roth conversion of 10,000, and that drives their income up to 200,000. They have now crossed the IRMAA threshold. So IRMAA goes into effect. So here's what that conversion is going to look like. The $10,000 Roth conversion is going to trigger an additional fees of that $1,874 that IRMAA applies just from doing a $10,000 Roth conversion. That means that the shadow tax, if we want to call it that, from IRMAA is really about 18% of that Roth conversion. Right? So you're paying an additional $1,800 on a 10,000 conversion. That's about 18%. And at that point on the marginal tax bracket in the year 2023, they're going to be in the 24% marginal tax on that as well when they claim that additional 10,000 in Roth conversion, which means that they effectively have paid a 42% effective rate on those Roth converted funds. That, I would say, in pretty much every scenario, but I'm going to leave myself a little loophole just because I want to play safe. But that is probably in most every case not going to be an effective use of Roth converted funds. Now, there's some things that they could have done differently in there. They could have said, hey, you know what? If we're going to go and have to pay that extra $1,874 IRMAA, let's just go ahead and convert more than 10,000 so we can spread that amount over a bigger Roth conversion. Maybe this would make more sense. But this would be, I'm just showing you an example of when IRMAA could be a big deal. And when you're thinking about doing Roth conversions, think through the implications of what that might mean based on where you're at in on your earnings, on the tax brackets, on when IRMAA kicks in and all that kind of stuff. Now, the takeaways from this is that sometimes it's a bigger impact than others when you're looking at IRMAA. Sometimes it's not a big impact, sometimes it is. Also keep in mind it's frustrating to have to pay more for the same service. No matter what you pay for your Part B Medicare premium per month, even if it's the base amount, or you get hit with IRMAA and you're paying more, you're still getting the same service. And although the dollar amounts might not be that big of a deal as a percentage of overall, there's still just something frustrating about having to pay more for the same thing. And probably the biggest takeaway is before you start doing tax moves and tax planning and things like that, make sure that you get advice and have an objective review done of your financial situation, because you could, like the example that I created a few slides back with the 10,000 Roth conversion. Well, I mean, that would be a really dumb move to make right there, where you're actually coming out worse than you would if you just left it in the IRA in that case, in that limited example that I gave. So make sure before you're doing any type of big tax planning moves, make sure you get advice, make sure you know what you're getting into before you do this, before you decide it. Because once you decide and you pay the tax to the IRS, that's it. You can't undo that. They've got the money now, and that's what has happened. Okay. And if you need additional help with your retirement planning, head on over to retirementplanningmadeeasy.com. Download a free copy of our essential step-by-step retirement guide. It's going to give you some good resources that you can use on your retirement planning journey. Thanks for watching, and I will see you guys on the next video.